It's as sure a thing as the cherry blossom festival in Washington at this time of year as well, that you will hear the IMF come out and make gloomy noises about EM generally.
Welcome back to Breakout from Breakingviews, brought to you by PGIM. I'm Peter Thar-Larsen, the global editor of Breakingviews, coming to you from London, and I'm joined for the first time by Felix Martin. Felix, welcome to Breakout.
Thank you very much, Peter. It's great to be here.
So Felix, you've written for us this week about emerging markets, and specifically you've been looking at what was happening in Washington earlier this month with the IMF and World Bank meetings that happen every spring, and particularly the sort of gloomy noises that were coming out of the IMF about emerging markets. Particularly, I think you reference some comments made by Kristalina Georgieva, the managing director of the IMF, where she said as many as 60 emerging market countries could be facing some sort of debt distress. Now, you say, you have quite an interesting angle on this. You say that this is like a seasonal, regular, annual event from the IMF. What do you mean by that?
I say, it's as sure a thing as the cherry blossom festival in Washington at this time of year as well, that you will hear the IMF come out and make gloomy noises about EM generally. And what's behind it, of course, is both that there is something serious in what they're saying. There is a subset of EM sovereigns, and that's generally the lower income and low middle income sovereigns. It's mostly sub-Saharan African sovereigns who are at risk of debt distress at the moment. But for most of them, it's really to do with the fact that the IMF and the World Bank, they're the two institutions that have these meetings in spring each year, they have to go out and raise capital from their shareholders in order to do concessional lending. And when that capital is exhausted, they need to go and raise more. And of course, it never does to paint too rosy a picture of the prospects of the emerging markets in that case. Otherwise, no one will stump up capital, particularly in straitened times like these.
So you're a bit more sanguine about emerging markets for a couple of reasons. I guess partly because they've just come through what you consider to be a bit of a stress test. So how do you think about that?
I think they've actually been through two pretty important stress tests. One over the whole of the last year, and this was a very classical stress test. This was basically the very rapid Fed hiking cycle that we've seen over the last year. Now, typically, historically, Fed hiking cycles, raising the cost of dollars, that has been pretty difficult for emerging markets in the past. It's the kind of thing which has created EM crises, and therefore a lot of investors have a kind of muscle memory, that this is going to be awful. It's going to cause sudden stops in capital flows and some sort of balance of payments crisis, that sort of thing. In fact, this time round, that really hasn't happened. Currencies have been pretty resilient against the dollar. We haven't seen, blanket big sell-offs in EM currencies. There have been some exceptions, but equally, some of them have actually strengthened over the last year. And the same thing with EM bond yields. They have actually, in most cases, gone up much less than US bond yields, for example. So that's unusual. And the basic reason is the central banks in these countries, in the major EMs, a lot of them got ahead of the Fed and started hiking before the Fed. And that really hasn't happened before.
But it's interesting the point you make, because essentially what you're saying is in the West, in the Western economies, we have this sort of very long period of low interest rates, central banks buying bonds and stuff, and that just simply hasn't happened to the same extent in these emerging markets, even though the monetary conditions in the US and elsewhere are very loose.
No, that's right. I mean, and by the way, it didn't happen. There's no sort of mystery as to why it didn't happen in EM. I'm sure a lot of these countries and their central banks and monetary authorities would have loved to do the sort of thing that was being done in G7 countries. But of course, market discipline really still applies in most of these countries. They really don't have the luxury of doing a lot of that stuff. So again, with one or two exceptions and grey areas, that kind of extraordinary policy wasn't possible. Equally, for example, the kind of fiscal expansion, taking on a public debt that we saw during COVID in the G10, that hasn't really been possible to the same extent in a lot of EM countries. So in that sense, they've been in a better position, I'd say.
Yeah, I mean, you have this amazing stat. I think, what is it? The average debt to GDP, or the aggregate debt to GDP of the EM countries is what, 65%, and
yes, it's only around 65% now, and it's it's double that in the G7, 130%. It was actually 140% of GDP in 2020. It's come down a bit as a result of high inflation
right.
in the G7, but yeah, much higher. Of course, we'd expect EM countries to be able to probably tolerate a lower level, so we shouldn't get too excited about it. And just to say again, the IMF's not wrong, of course, that there is a subset of very low-income countries who have got some debt problems at the moment.
Or even there's an irony, obviously, which is that the main creditor for a lot of those countries is China, which in itself is considered an emerging market. I mean, yeah. I guess sort of maybe just to wrap up on this, it sort of does come back to this time-honored question, which is there any point in still talking about emerging markets as a separate group?
Yes, I mean, one can debate that question all day long. I mean, there's obviously a big spectrum these days, and there are some of these emerging market countries which are so large. China is the canonical example, but there are others following close behind. That it probably doesn't make a lot of sense to lump them in with the really low-income countries. And I think that's actually the actual fundamental message of this column that I've written is, don't be too distracted when you hear these or read these headlines or hear these noises about EM, because very often what's being referred to is a group of countries, very low-income countries, which aren't that relevant to investors. For portfolio investors, the EM countries which are important are the middle income and the larger countries. And those, it's a very different story and a much more interesting story for investors.
Felix, this was really fascinating. Great to have you on, and look forward to talking to you again soon.
Same here.